If you've ever looked at Bitcoin, Ethereum, or the latest crypto headlines and felt like everyone else got the manual except you, you're not alone. A lot of smart people hear the words blockchain, wallet, mining, staking, digital assets, and decentralized finance, and it all starts sounding like some secret language invented by the internet to make ordinary people feel late, confused, and maybe a little broke. And that feeling matters because whether you ever buy a single dollar of crypto or not, the world is already moving deeper into digital finance. Money is becoming more online, more programmable, and more global. So if you don't understand how cryptocurrency really works, you're not just missing an investment trend, you may be missing how the future of money is being built around you. And the dangerous part is that confusion makes people easy to manipulate. It makes them vulnerable to hype, fear, scams, and costly mistakes. So in this video, I want to do something different. No hype, no get-rich-quick nonsense, and no pretending this stuff is simple when it isn't. I'm going to explain how cryptocurrency works from the ground up in plain English. So by the end, you'll understand what blockchain is, how crypto transactions work, why Bitcoin was created, what miners and validators actually do, what wallets really hold, why prices swing so wildly, where the real risks are, and how to think about crypto like an adult instead of a gambler. To understand cryptocurrency for beginners, we have to start with a simple question that most people never ask clearly enough. And that question is this: what is money really? Most people grow up thinking money is cash, coins, bank balances, maybe credit cards. But money is really a system of trust and accounting. It's a shared agreement about value, ownership, and exchange. If I pay you, there has to be some reliable way for society to agree that I gave something up and you received something of value. In the traditional system, banks, payment processors, and governments play a huge role in maintaining that trust. They keep the ledgers, they verify balances, they settle transactions, they reverse fraud in some cases, freeze accounts in some cases, and create the rules of the system. Cryptocurrency changes one major piece of that equation. Instead of relying on one central institution to maintain the ledger, it uses a distributed network of computers to agree on who owns what. That's the breakthrough, not magic internet money, but a new way to keep records and transfer value without needing the entire system to run through a single gatekeeper. That's where blockchain technology comes in. If you've heard people ask, what is blockchain? Here's the cleanest answer. A blockchain is a shared digital ledger that records transactions in blocks of data, then links those blocks together in chronological order so altering the past becomes extremely difficult. Imagine a giant public spreadsheet that thousands of computers around the world all keep a copy of. Every time new transactions happen, the network has to agree that they're valid before adding them to the spreadsheet. Once they're added, they're grouped into a block, and each new block is mathematically connected to the one before it. That chain of blocks creates a history that is transparent, time-ordered, and very hard to tamper with. So when people say blockchain is revolutionary, what they really mean is that it allows strangers on the internet to coordinate around a shared record of truth without needing to fully trust one another. That might sound abstract, but it's actually a very human idea. We've always needed ledgers. The innovation is that now the ledger can be global, programmable, and decentralized. Now, let's talk about decentralization, because this is one of the most important ideas in all of crypto, and also one of the most misunderstood. Decentralization means no single person, company, or government has total control over the network. Instead, control is spread across many participants, often called nodes, that help verify and store the data. Think of it like the difference between one company owning the only copy of an important database versus thousands of independent computers, each holding a copy and following the same rules. If one node fails in a centralized system, that can create a major problem. If one node fails in a decentralized network, the system usually keeps going because the rest of the network still has the record. That doesn't mean crypto is somehow outside reality or immune to power, politics, or regulation. It just means the architecture is designed to be more resilient, more open, and harder for any one actor to control. This is why Bitcoin, explained properly, is not just about price. It's about the idea that value can move on an open network the way information moves on the internet.
Bitcoin was the first major cryptocurrency to make this idea work at scale. It showed that digital scarcity could exist without a central issuer. Before Bitcoin, digital files could be copied endlessly. If money became fully digital, how would you stop someone from copying it and spending it twice? That problem is called the double spend problem, and Bitcoin's solution was elegant. It used blockchain technology plus a consensus mechanism to make the network agree on one valid history of transactions. Consensus is just a fancy word for how the network decides what's true. If thousands of computers are maintaining the ledger, they need a system for agreeing on which transactions are valid and which version of the ledger is the correct one. This is where proof of work and proof of stake come in. And if you understand these two systems, you understand a huge part of how cryptocurrency really works. Let's start with proof of work, the system Bitcoin uses. In proof of work, specialized computers compete to solve a difficult mathematical puzzle. The first one to solve it earns the right to add the next block of transactions to the blockchain, and in return, it receives newly created coins plus transaction fees. This process is called mining. Now, the puzzle itself isn't useful in the everyday sense. It's useful because it makes attacking the network expensive. To cheat the system, an attacker would need enormous computing power and electricity, which makes fraud economically difficult. That's the key idea: security through cost. Miners are essentially spending real-world resources to help secure the network and validate transactions. The downside is obvious. Proof of work can use a lot of energy, and it tends to favor people who can access cheap power and specialized hardware. But the upside is that it has a long track record, and many people see that costliness as part of what gives Bitcoin its strength and credibility. Proof of stake works differently. Instead of spending energy to compete, participants lock up or stake their coins as collateral. The network then selects validators to confirm transactions and create new blocks, usually based on how much they've staked and other rules designed to keep the process fair and secure. If validators act honestly, they earn rewards. If they try to cheat, they can lose some of their stake. So instead of security coming mainly from electricity and hardware, it comes from economic incentives and penalties. Ethereum, the second largest cryptocurrency network, uses proof of stake now, and this matters because it shows that blockchains can evolve in different ways depending on their goals. Proof of work and proof of stake are both trying to answer the same question: how do you get a decentralized network to agree on truth without trusting a central authority? They just solve it differently. One uses energy and computation, the other uses capital and incentives. Now let's make this practical and talk about how crypto transactions work, because this is where a lot of people think things get mysterious when they really don't. If you send cryptocurrency to someone, you're not sending a physical object. You're updating the ledger to show that control over a certain amount of value has moved from one address to another. To do that, you use a wallet, and this is a major point of confusion. A crypto wallet does not literally store your coins the way a leather wallet stores cash. Your crypto lives on the blockchain as a record of ownership. What the wallet stores are your keys, especially your private key. Your public address is like an email address. You can share so people can send you funds. Your private key is more like the master password that proves you control that address. If someone gets your private key, they can control your assets. If you lose it, you may lose access permanently. That's why people say in crypto, self-custody brings freedom, but it also brings responsibility. When you make a transaction, your wallet uses your private key to create a digital signature. That signature proves to the network that you have the authority to move those funds without revealing the private key itself. The transaction is then broadcast to the network where nodes check whether it follows the rules. Do you actually have the funds? Is the signature valid? Are you trying to spend the same coins twice? If the transaction passes those checks, it goes into a waiting area, often called the mempool, until miners or validators include it in a block. Once it's added to the blockchain and confirmed by the network, the transfer becomes a permanent ledger. This is one reason crypto can feel strange at first. There's no bank branch, no cashier, no one pressing approve behind the scenes in a visible way. It's software, cryptography, game theory, and distributed consensus all working together so value can move between people who may not know or trust each other.
This also helps explain why transaction fees exist. On many networks, when you send crypto, you pay a fee to help compensate the miners or validators who process and secure the transaction. Those fees can rise when the network is busy because block space is limited. Think of it like paying more for faster shipping when demand is high. Some blockchains are designed for security above all else. Others try to optimize for speed, lower fees, or programmability. And that brings us to another huge evolution in blockchain technology. Crypto is not just about sending digital money from person to person. Some blockchains, especially Ethereum and similar networks, can run smart contracts. A smart contract is basically code that executes automatically when certain conditions are met. That means people can build decentralized applications on top of the blockchain, from lending protocols to digital collectibles to tokenized assets to entire financial systems that operate without traditional intermediaries. This is where DeFi enters the picture. DeFi is one of the clearest examples of why crypto matters beyond speculation. In traditional finance, if you want to borrow, lend, trade, or earn yield, you usually go through banks, brokerages, or other institutions. In decentralized finance, software protocols can offer versions of those services directly on the blockchain. That doesn't automatically make them safer or better. In some cases, it absolutely does not, but it does show that blockchains can be used to recreate and rethink financial infrastructure. Stablecoins are another big part of this story. These are cryptocurrencies designed to maintain a stable value, often pegged to the US dollar. For many users, stablecoins are more practical than volatile assets like Bitcoin because they allow faster digital transfers without the same level of price swings. In the future of money conversation, stablecoins may end up being just as important as the more famous cryptocurrencies because they connect the world of digital assets with the familiar logic of everyday pricing and payments. But if crypto is so innovative, why do so many people still feel burned, skeptical, or intimidated by it? Because the technology is one thing and human psychology is another. A lot of people don't lose money in crypto because they misunderstood blockchain. They lose money because they misunderstood themselves. They chased hype. They bought because of FOMO. They ignored risk because everyone on social media sounded confident. They confused a rising price with a solid foundation. This happens in stocks, housing, startups, and almost every asset class. But crypto moves so fast that it exposes emotional decision-making in extreme form. Loss aversion kicks in when prices fall. Greed kicks in when prices rise. Recency bias makes people think whatever just happened will keep happening forever. That's why one of the most valuable things you can learn from crypto investing basics is not how to find the next big coin. It's how to think clearly under uncertainty. Knowledge reduces emotional vulnerability, and in markets, emotional vulnerability can get expensive very quickly. Volatility is one of the biggest realities in crypto, and it's not a side issue, it's central. Crypto prices can move dramatically because these markets are still relatively young, highly global, open around the clock, and heavily influenced by liquidity, regulation, macroeconomic trends, adoption news, and investor sentiment. When interest rates rise, speculative assets can suffer. If regulators announce crackdowns or approvals, markets react. If a major exchange fails, trust gets shaken. If institutional adoption grows, confidence can rise. So when people ask whether crypto is real, the better question is, what part of crypto is real? The technology is real, the networks are real, the use cases are real. The risks are also very real. Some projects solve meaningful problems, others are mostly marketing. Some tokens may become part of the financial infrastructure, others may disappear completely. That's why long-term thinking matters. Instead of asking, how fast can this make me money, a smarter question is, what does this network actually do, who uses it, how is it secured, and why would it still matter 5 years from now? Security is another place where people need a realistic view. Crypto can be incredibly secure at the protocol level, but individuals can still make painful mistakes. The blockchain itself might be hard to hack, but your email, your exchange account, your phone, or your own habits may not be. Phishing attacks, fake websites, social engineering, and bad custody practices cause a lot more damage than some dramatic Hollywood-style attack on the blockchain. If you leave assets on an exchange, you are trusting that company to safeguard them. That may be convenient, and for some people it may be appropriate, but it's different from self-custody.
If you hold your own keys, you remove one layer of third-party risk, but you also become responsible for backups, recovery phrases, and operational security.
There is no help desk that can magically restore your funds if you send them to the wrong address or give away your seed phrase. That's not meant to scare you away, it's meant to help you respect the system. Freedom without responsibility is just another fantasy. Now, let's talk about regulation, because crypto does not exist in a vacuum. In the United States and Canada, regulators, lawmakers, financial institutions, and businesses are all trying to figure out how digital assets fit into the broader economy. Some regulations are aimed at protecting consumers, reducing fraud, and preventing money laundering. Some rules may also slow innovation or create confusion, depending on how they're written and enforced. But one thing is clear. Crypto is increasingly intersecting with traditional finance, not replacing it overnight. You're seeing more conversations around ETFs, custody solutions, tokenization, payment rails, compliance, and the role of blockchain technology in business infrastructure. In other words, crypto is maturing. It's moving from the edge of internet culture toward a more complicated relationship with mainstream finance. That doesn't mean every project survives. It means the conversation is becoming less about rebellion and more about integration, standards, and real-world utility. So, where does all of this leave the average person who just wants a grounded answer to how cryptocurrency works and whether it matters? Here's the honest answer. Crypto matters because it introduces a new model for owning, transferring, and programming value online. It gives us digital scarcity, open financial networks, and systems that can operate across borders without relying entirely on traditional intermediaries. It also brings serious trade-offs, serious risks, and a steep learning curve. That's why the smartest way to approach crypto is with curiosity, humility, and discipline. This is for educational purposes, not financial advice. And the goal is not to pressure you into buying anything. The goal is to help you understand the system well enough that if you ever do participate, you do it from a place of competence instead of confusion. Learn what a wallet is. Learn how private keys work. Learn the difference between Bitcoin, explained as a store of value network, and other blockchains built for smart contracts. Learn how crypto transactions work before moving real money. Study security before chasing upside. And if you ever invest, do it in a way that fits your actual financial life, your time horizon, and your risk tolerance. Because in the end, this isn't just about coins. It's about understanding the world you live in. Every generation has to learn the systems that shape its opportunities. In the past, that meant learning how banks work, how credit works, how taxes work, and how investing works. Today, it may also mean understanding blockchain, digital assets, and decentralized finance well enough to separate signal from noise. You do not need to become a developer. You do not need to become a trader. But if the future of money is becoming more digital, more global, and more programmable, then understanding the basics is part of being financially literate in the modern world. And honestly, that may be the biggest payoff of all. Not getting rich overnight, but becoming harder to fool, harder to intimidate, and better equipped to make calm, informed decisions when everyone else is reacting emotionally. So now, I want to hear from you. Before watching this, what part of crypto felt the most confusing? Blockchain, wallets, mining, staking, security, or just the whole idea of Bitcoin and digital money? Do you see cryptocurrency as a genuine part of the future of money, or do you think it's still too risky and misunderstood for most people? And what topics should I break down next? Crypto investing basics, how to store crypto safely, how decentralized finance works, or how blockchain technology could change business and finance over the next decade? Drop your thoughts and questions in the comments section, because I read them and your questions often shape the next video. If this helped you finally understand how cryptocurrency really works, make sure you like the video, subscribe, and share it with someone who's curious about crypto but tired of the hype. And if you want a deeper breakdown of where crypto fits into long-term wealth building, risk management, and the changing financial system, check out the next video. Because understanding the technology is step one, but knowing how to think about it wisely is where real confidence begins.
Hope you enjoyed watching this video.
Drop your comments and questions below. Your comments and questions might inspire someone else in this community. Have an amazing day. Keep learning, keep growing financially. And I look forward to seeing you in the next video.